All right, guys. The basics of market structure made you to understand that market moves in three ways. We have the bullish structure, which occur in this form. Bullish structure occur in this form. As you can see, this is what we consider as a bullish structure. So either market is moving in this direction or it is moving in this direction, which is what we consider as bearish structure. All right. So this is a bearish structure, or the market is moving in a range. All right. So which is this form? Either the market is moving in this form. So there is nothing else that the market is doing. Although we have what we call choppy, but let's not go into that choppy market. All right, or choppy structure. The major one is these three types. So we have these three basic market structure. We have the bullish structure, the bearish structure, and what the ranging structure. All right, I want you to focus on what swing structure. What does that mean? How does that come about here? For a bullish structure to occur, it must involve swing structure. What does swing structure mean? If you look at this chart here, you are going to see this is a move. You see this move from here to here. The move from here to here is a swing. That is swing high. The move from here to come down is a swing low, swing high, swing low, swing high, swing low, swing high, swing low. I don't know if you get it. The same thing here. Swing low, swing high, swing low, swing high. So it's basically swings that made up either a bullish structure or a belly structure. So you see swing structure in a bullish or bearish structure. I don't know if you get the point now. So having understand that this is basically the basis of market structure. All right. So the same thing here. If you come to the market here, let me just show you a kind of example of what I'm trying to explain to you. If you look at this market from here to here is what is uptrend, which is bullish structure. Uptrend is the same thing as bullish structure. Coming back to the illustration I want to show you now, what are we looking for in the market? Since we have already understand that a swing occur like this is a swing. All right. When markets take this kind of, what are you expect? You wait for it to come back here again so that you enter for the next up move. I don't know if you understand. So this is a swing structure. To show you a setup that can help you understand what you are doing. So if you take a look at this chart, let me go to a kind of 2 hours time frame so that you see the bigger picture. If you take a look at it, this is a setup. So if you look here now, you see that in this scenario, this is a setup I'm already waiting on. So you see that in this scenario, here we have a breakout structure. So I hope you can see it. Then we also have this low, the last low. So when you have something like this, it's expected that this low is protected, meaning that if this market is coming down, it is not expected to break below here. All right. You only wait for the market to either come to this region, or if the market continue going up along the line, it's going to give us another pattern that is going to show continuation, just like you see here, markets keep going up. All right. So this is a break of structure. This is the low that is protected. All right. Then this region is where we are expected to trade. But let me give you another example where we have in the market. All right. If you come down here, the one that have already occurred, let's say we come to 1 hour time frame. In 1 hour time frame, if you come down here, I took this trade. So in 1 hour time frame, if you come down here, you will see here. Remember, the first one I just finished showing you is a buying setup. So this one is a sell setup. What happened here? If you look here, remember in a sell setup, we are looking for downtrend. This is a downtrend. Then around here, that is where our pattern form. Pay very close attention. Here, you see that we have this high, all right? Now we have a break of structure here. You see, when market move from here to here, come down, you see that the market, you see the break of structure, this market break here. So we have a break of structure. In the other one was a buying setup. This one is a selling setup. So if you see something like this, we expect this place to be protected. Meaning that if this market is pulling back, we are not expect it to come above here. All right. Now here is the region where we are going to enter. Just like you can see here, in this case, market actually come to our region. After it break below here, it come back to this level. So as it come back to this level, now we can actually enter our trade around here. So here becomes where we enter our trade, and our stop loss will just be around here. We can be able to capture the trade down depending on what you want as your take profit. This is the one that have already occurred, which is the same thing we are expecting here. Here, as you can see, we have this level, the break of this structure. This is the row that is protected, but the market have not started coming down. It might not come down, but if it eventually comes down to our level, this will be what we are going to be trading on. I don't know if you get the point. So, but the question now is, why is it that we did not see all this place now? I did not show this setup here. So there is something that made me to choose here instead of all this. All right. So that is what I want to explain to you now. There are factors that validate our setup. All right. There are factors that validate our swing structure. All right. What am I trying to say? I'm trying to say that if you look from here, why is it that I didn't start here? Is it this is not a break of structure? Why is it that I choose this particular region? So that is what I want to illustrate to you now so that you understand how it works. So factors that validate swing structure. So I want you to pay very close attention. The first one here you will see. So let me illustrate that for you. So what we expect is a sweep of the previous low. This is the previous low. So the sweep of this previous low, then a break of structure. So when you say, as you can see here, you see the break of structure here. See, if you look here now, you see the break of structure. So the factors that validate our swing setup, number one is the sweep of the previous low, which is what's happened here. You see the market break this particular level. All right. Then the second one is the break of structure. The sweep of the previous low for a buying setup. If it is a selling setup, is the sweep of the previous high. I want you to know the difference. The sweep of the previous low for a buying setup, or the sweep of the previous high for a selling setup. All right. Then the second factor is the break of structure. As you can see, the market sweep this particular low. Then what next do you expect? You expect the market to kind of start, you see small move coming down like this until it comes to our level. Here now becomes our level where the market is going to take up here. So at the end of the day, this, let me come. So here now becomes like this small move can be considered as a substructure. So this big move is what we expect the market to get. So when it reach to this level, we expect that here is our region where we can be able to buy. So but here, these are the two factors that we must consider. Let me show you in the market the same thing. If you come here now, you see that here we have, before we say that here, this is the point we are waiting for, we have the sweep of previous low. Even at this point, see, look at it. This is the sweep of the previous low, and immediately we have the sweep of the previous low. What's happened next? You see the break of structure. The market break this structure. That's why we considered here. We did not use this one. We did not use down here. The same thing come here. You see, from here, we did not see any sweep of previous low with break of structure here. All right, that give us what we are looking for. So high, As you can see here, you see the sweep of the previous low, then the break of structure. That is why we considered this region as our entry. Not this one, not this one, not this one. All right. The sweep of the previous low. This is the previous low. Then the market break above it. That is sweep of the previous low. Then come down here. We had what? The break of structure. All right. So that is the reason why we consider this. So these are the two factors that validate our swing setup. I have just shown you in a buying setup, example of that, and in a selling setup. All right, just like I show you here. Okay, so these are the things you need to pay very close attention. You can be able to watch it and watch it again so that you understand what I'm saying. So we have this. We have, for instance, the sweep of this previous low, then the break of structure. All right. So when you have this now in the market, what do? You expect that this place should be protected. This is for a buying setup. And here, so when you have the sweep of the previous low, as you can see here, this is the previous low. This place just the market break below here. Then you see this region now is the break of structure. Here is the sweep of the previous low. All right. So the factors I'm talking about for a buy setup is we must have the sweep of the previous low, meaning that the market will break below here. Then the second thing that will happen is after the majority market break below here, you see the market turn around. Then the next thing we have the break of structure here. So when this thing happen here, from here to here becomes the region where we are going to be waiting to trade this market. All right, here is where we are going to be waiting to trade this market from here to here, this region. Don't know if you understand what I'm saying. So this region now automatically becomes where we are going to be trading from. All right, so this is only for what? For a buying setup. For a selling setup, the same thing you expect the market. Let's say you see this move, you see the break of this structure, sorry, the sweep of the highs, then you see the break of structure because the market is coming down here. This is a selling setup. All right, so in this scenario now, what are we expecting? We expect this region, you see here, the second one is this side. So we are going to be trading around this region. You see, from here to here, that is where we are going to be trading. This is what this one is in a sell setup. Here is this place is this sweep of the low. Then here is the break of structure. Let me come again. This is the break of structure. And okay. Lest you forget, I said that there are factors that validate our swing setup, and the first one is the sweep of the previous low or previous high. For instance, now in a certain setup, as you can see, this is a certain setup. Let's say you see a downtrend and this kind of pattern form. What do? You must wait for what? A sweep of the previous low, as you can see. That is rule number one. In a selling setup, is sweep of the previous high. In this one, which is a buying setup, is sweep of the previous low. That's why I said that one of the factor is there must be a sweep of the previous low or a previous high. Do you understand? Then the second factor is there must be a break of structure. What's happened here? You see, after market make this move, you see there is a sweep of the previous high in a certain setup. As you can see, market come here and wipe this thing, and immediately it sweep this level, the market drops. Then the second one, as the market is coming down, it didn't just stop here. it come down here and do what and give us this level which is considered as a break of structure. So that is the two factors that you must consider: the sweep of the previous low or previous high, or the break of structure. Two. Then when this setup is come, what happened? We are expected to trade in this level. This is the level that we are going to trade. As you can see, this is a buy setup, the sweep of the previous low, then the break of structure. That is the two factors that we are looking at. After this happen, this region is the region we expect to trade. All right, this region is the reference because we are expecting the market to come down to this zone, around this zone. But at what exactly? Is it this point? Is it here? Is it here? Is it here? Are we going to be buying? All right, so that is what I'm going to be teaching you now. That is what we call how to identify the zone. Because if you already know, if you see something like this, you already know that you are going to be buying. What level? What if this market start coming and reach this level? Should I buy, or this level, or this level, or should I expect it to come and sweep this low? No. Then we use what we call Fibonacci to determine that. There are two ways you are going to be using it. I want you to pay very close attention so you understand the difference. In a buying setup like this, for us to determine the level, what zone are we going to be buying from? We are going to use a Fib level. If you don't know how to, if you can see here, if you open your Fibonacci, I take it from down here, the last low, all the way to up where the market stop. All right. From here, I drag it all the way up here. 1 and 0 should be at this point. So why 50% retracement is this zone? So I want you to pay very close attention. After you have established, after you don't see these two factors in the market, now the next thing you are waiting for, the step 2, is that you are asking yourself, what region or zone am I going to be buying? So do not, if this market starts coming down, let me just show you illustration. If this, remember, market is here. For instance, the market start coming down from here. You see, let me do it where. Pay very close attention. Then market is here, right? Then it start coming down. At what point? Is he here? Is he here? Is he here? Do I start buying? You are not to start looking for a buying setup until this market touch 50% retracement. If it come down to 50% retracement, or it come below 50% retracement. That is rule number 1. You understand? For a swing setup, in your Fibonacci, you must wait. You understand? For a swing setup, while using your Fib level to determine, when I teach you liquidity, you're going to understand that you must wait for the market to come below here before you start looking for entry. That's how it works. All right. So for instance, this market, either it come here or it come anywhere below here. It could be here, it could be here, it could be here. You understand? That's the only time you start looking for setup. You start waiting for the next one, which I'm going to introduce in the next video. Make sure you don't miss any of this video. Then if you take a look at this one, the same thing, because the market break this structure now, you expect it to come down. So where are you going to be entering your trade? Let me delete this. You pick your Fib level. You understand? You capture it from the high all the way to the last point where the market is. So if this market start coming down, for instance, let's say for instance the market start coming from here, start coming here, you are not going to trade it until it reach this 50% level, or anywhere, even if it's inside. That's the only time you start considering to enter the trade.